Saying that, thank you very much. I'm quite happy of having the opportunity to present this work here, and I missed also, like in the course, not having had the given the circumstances, the chance to be there in Santiago physically, but I hope next time. So this is joint work with Beatriz González, who is a colleague at the bank, Dominic Thaler from the ECB, and Silvia Riccio, now at the IMF, and the usual disclaimers apply. Okay. So, I mean, this now in these COVID times, this paper may sound. I mean, now in the last few months, inflation has been the main concern of central banks in most countries. But before inflation, there was a previous concern that that was voiced by several senior central bankers, and that has also been relatively relevant here in Europe, which was the concern that the ultra expansionary monetary policy that has been conducted in several advanced economies since the Great Recession and has produced or is related to, I mean, is the cause or the consequence that I will not get into, but has led the world, or at least those economies, to a situation of low real interest rates. Okay, I'm not gonna make any claim about whether it was the low natural rates, the ones that force the central banks to run this or not. So this is not about this. But what is true is that there was a concern, and there are several, especially empirical papers, discussing the issue of how low real interest rates may lead to capital misallocation. In addition, there are like 3 influential papers, theoretical and empirical papers, discussing those issues that I would like to highlight. The first 2, the ones of Ricardo Reich and Gita Gopinath and co-authors, discuss the situation in some Southern European countries before the Great Recession. So more than 1 decade ago, in the years from the 1999 to 2007, countries such as Portugal or Spain experienced huge inflows of capital, and they experienced a large reduction in the real interest rates after they enter the Eurozone, the European Monetary Union. And there are reasons to believe that, and those papers, they forcefully argue that this reduction in real interest rates produced capital misallocation, as capital was redirected towards less productive firms. There is a more recent paper by Vladimir Asrian and co-authors that makes a similar point, also in a more general equilibrium environment. Okay. And the idea is that in all these models, what you need to have, so those are, I mean, the 3 of them are real models, not nominal models. And the idea of these models is, and they are positive models and real models. And in those models, the key issue is that if you combine firm heterogeneity with financial frictions, what you have is that some firms, more productive firms, typically high productivity firms, they cannot grow more than their current net worth. I mean, a multiple of their net worth. So in the event of a reduction in real rates, those firms cannot enjoy most of this reduction in real rates. It is instead much less productive firms, which are close to the fringe, the ones that enter the market or that began producing because they were not producing, and then they are the ones that enter the market. So at the end of the day, given the reduction in real interest rates increases the amount of capital, but most of this capital is devoted to these firms that were close to the fringe. Okay, let me put it in a very simple example that I like to put to illustrate the idea of these papers. Imagine that you have this pet project, which is to open an ice cream shop in Santiago. Okay, the return of this is 1% real. Okay, if real interest rates are 5%, then you keep on working at the Central Bank of Chile, doing whatever, working in a private bank. However, if real interest rates go down below 1%, now suddenly this pet project of you that was totally unprofitable before now turns profitable, because now you may decide, okay, it is worthwhile to quit my job and to devote my capital, to sell my house and to invest the proceeds of my house, of my company, of my savings in stocks, whatever, into my ice cream shop. Okay, so that what it produces is that it keeps constant or increases the total amount of capital, but reduces average productivity. So that's the bottom line of these papers. Then, so the current state of the art is that a number of papers have shown how, under particular circumstances, a reduction in real interest rates may affect capital misallocation. But then, these papers differ in certain elements. They are all real models. So the first question that we made, they are real models. They are very partial equilibrium. The one by Vladimir Asri and so on, they have more elements of general equilibrium. They introduce also capital prices, but they don't have wages. So they consider first kind of a small open economy. So the first question that we made, thinking about the paper, was really, if you really analyze a closed economy, monetary economy, does monetary policy produce capital misallocation? And the second question was, okay, independently, what this literature is highlighting is that for good or bad, there seems to be a link between financial frictions, firm heterogeneity, and monetary policy, capital misallocation. So then, let's assume, no matter what, that that monetary policy can increase capital misallocation or reduce it. In any case, how does this link between capital misallocation and monetary policy affect what we know about how monetary policy should be conducted optimally? We know this, you take Galis or Boot for Book, and there are a number of receipts about divine coincidence, leaning against the wind. How, which of those lessons survive once that you consider a more realistic model that includes firm heterogeneity and capital misallocation? Okay. So those are the questions.
Galo?
Yes.
This is Ernesto Pasten from the bank. I am, since you started very broadly, probably we could talk a little bit about the broad points that you were bringing to the table. The first one is that I see a tension between bullet 1 and bullet 2, because in bullet 1 we said let's go agnostic, and real rates has been down for some reason that may imply some capital misallocation. But bullet 2 assumes that monetary policy has something to do with it, which is a little bit, it's one step further in the stream of thought. And then
I say may affect capital, may.
And then you mentioned financial frictions, but and here I'm probably being unfair with you and the paper, but most of the time when people talk about financial frictions, the specifications is basically a rabbit in the hat. There is no empirical evidence that when we put in models and we tell this is the determinants of financial frictions, is really what is financial frictions in the reality. So probably we should have something like, and this is nothing to do with the paper really, we should probably think about optimal contracts with some frictions that look like real contracts, and then we can pose the questions, that are in this slide one, no?
Yeah, I mean, you're totally right in the sense so about first point, yeah, it's true that at this stage, and we began that, and when we present the results, that taking as given that that money, as you said, the papers that exist are all real papers, and they are all very partial equilibrium. I mean, the Gopinath one, which is probably the most famous, is the Quarterly Journal of Economics. It's mainly an empirical paper, and then it has a model. And the idea of the model is that it's a partial equilibrium model in which wages are constant and real interest rates are exogenous. So in that paper, what you have is that an exogenous reduction in real interest rates increases misallocation precisely through this channel, through the channel that it modifies the funding cost of companies. Large companies cannot grow, and small companies companies that were outside of the market now enter the market. Let's put it like that. Then the issue is that all this literature about, or most of the literature about firm heterogeneity and misallocation, I mean the Xian, Kleno, Moll, Midrigan, and so on, they always assume as financial friction this kind of capital constraint, in the sense this borrowing constraint, collateral constraint, that the maximum amount, the assets of a company are limited by an exogenous multiple of its net worth. We borrow exactly that specification. Whether if that specification is realistic or not, that I cannot answer. I mean, that in that way we jump on the shoulders of all these other people. I know that there are,
but there is a big difference. Sorry for interrupting, but there is a big difference there, because in those type of models, the financial friction is just one element, and probably for the type of question that they have, a reduced form on the exact functional form of the financial friction, it's okay. For some other questions, this reduced form may not be okay. And if I understood correctly for your introduction, I think that the monetary policy is going to enter here through the specific reduced form that you're going to be assuming on the financial friction. Is that right?
no, in that way, no. Monetary policy. Let me defer the answer to that. Give me 2 minutes, and then I will ask you. So let me explain how we do it, and now you tell me whether you consider that it enters through that or not. So the way that we do it is the following. What we take is, and we precisely because we wanted to avoid this issue about our model. What we took was a completely off-the-shelf model, which is Ben Moll's job market paper. That's a model of heterogeneous firms with financial frictions. It's true, and I will grant you. I mean, I think that your comment was quite fair. For instance, that the Ben Moll's paper it's a very nice paper. It's a very tractable model with some interesting insights. But for instance, now there is a paper by Anmol Bandari and co-authors that working exactly in the same model, replacing the assumption, this ad hoc assumption of the financial friction, by an optimal contracting issue, and he finds that that the replacement of that totally modifies the result of the paper. So your point is totally valid. So it's true that these kind of changes may overturn the result. So in that way, I will make, and it's true also that that Moll's model makes some assumptions. I mean, all the models about heterogeneous firms make some assumptions. I mean, this is unavoidable. In the case of Moll's model, the key assumption is that firms are assumed to operate with constant return to scale technology, whereas typically people consider that heterogeneous firms should operate with decreasing return to scale technology. So, but I mean, any paper in the literature about monetary policy and heterogeneity makes some assumptions. So there are this literature, I will discuss it a little bit later, the Otonello Winberry or the Jenas paper, which are a little bit of the two most famous papers in this literature. Also, they cut corners in different dimensions that probably are less relevant for the kind of question. So I don't know, whereas this issue of assuming this leverage ratio I can say that it is the standard in this literature. What I cannot say that if you replace that by another assumption, it will be innocuous or not. That I don't know. And but about the transmission of monetary policy is not transmitted through the financial friction of the firm. So monetary policy is transmitted through a standard New Keynesian model, and then in that is on top of this structure. So essentially, what we are going to have is that these heterogeneous firms produce intermediate output, and those intermediate output are the ones that are purchased by by the standard monopolistic competitors of the New Keynesian model. This is more or less the structure of the model. So this is kind of a New Keynesian model on top of a heterogeneous firm model a la Mon. But then in order to, there are 2 points here. One, that the main technical contribution of the paper is that the issue of computing optimal policies in model with heterogeneous agents is a daunting task. It's something that so far there are the only papers that try to do something like that is a paper that I have with Carlos Thomas, a co-author from the bank, and a paper by Bandari, Evans, Golosov, Sargent in Econometrica, but they use a perturbation method that cannot deal with any kind of nonlinearity at the micro level, such as the one that we have here, for instance. And there is also a paper with using kind of finite memory by Rago, Legrand, and Martin Bayon, but they are all about households. So this is the first paper dealing with issues about optimal monetary policy with heterogeneous firms, with true heterogeneous firms. And then we present a new algorithm. So as most of the technical contribution of the paper is about methodologies, we didn't want to innovate very much into the modeling. So this is why we took the model that we consider that it was like the most plain vanilla model of heterogeneous firms that could be amenable for that. Then, of course, I'm sure that we are missing many elements, but what we didn't want to do was to introduce a new model with new elements, and then that people were unable to understand whether the results were due to the new elements or to the prescriptions of the optimal policy. So that was one point. And then a second issue that is not here but is important is that precisely in order to address the possibility that okay, yeah, but your model isn't realistic in this, which is something that in the first version of the papers 1 year and something ago people were raising. The paper also has a part discussing how things go with microdata. So we are also going to talk about granular data and what the data tells about the mechanisms highlighting the model. So it can be that the model is unrealistic, but the prescription of the model seems to be in line with the kind of things that we find in the data, which give us some reassurance about that even if the model is simplistic and unrealistic in a number of dimensions, that it does seems to produce results in key dimensions that are similar to what we obtain in the data. Does it answer the question?
Yeah, we'll see. We can discuss later.
It's better when we see the model. So just a quick overview of the result is that if we analyze the model in partial equilibrium, as most of these papers do, we obtain by the same mechanism, especially than the Gopinath paper, the same result, which is that expansionary monetary policy increases misallocation. Okay, this is positive results. However, when we move to general equilibrium results overturn that, because in general equilibrium is not only real interest rates that are moving, it's also wages, it's capital prices, and is the demand facing by the firms. And what we obtain is that let's say the Keynesian expansion that a positive and expansionary monetary policy shock produces increases demand for all the firms, but especially high productivity firms that has larger margins are in the sorry, I should not use the word margin. Sorry, that was incorrect. That have larger profits. Those firms enjoy more this expansion in demand. That allows them to accumulate more profits. By accumulating more profits, they can accumulate more net worth, and then they can grow more than low productivity firms. So at the end of the day, despite the fact that in theory there was this partial equilibrium effect, this partial equilibrium effect is overturned by the movement in wages and in other prices. And the overall result when you move to general equilibrium is that expansionary monetary policy shock actually decreases misallocation. Then you may say, is that a theoretical result? No. This is a completely calibration dependent conclusion. So, I mean, we'll have tried relatively sensible calibration, but it can be that for another calibration or introducing changes in the model, that the result would change. However, we have I mean, we are lucky at the bank because we have access to the quasi-universe of Spanish firms. So we have, like, I mean, almost all the Spanish firms, their balance sheet. And then what we do is this kind of local projection empirical analysis similar to the Ottonello and Wimberry to analyze the impact of a monetary policy shock on firm growth. And what we find is a similar result to the one that the model predicts, which is that facing expansionary monetary policy shock, high productivity firms grow and invest more than low productivity firms. So at least, I mean, the key mechanism that explains why the partial equilibrium result highlighted by the earlier literature is overturned when you move to a fully fledged New Keynesian general equilibrium model survives or is supported by the Spanish granular data. And we also know, even if it's not in the paper, it's in another paper being produced by some of my co-authors, that this also happens in the case of the US data. However, we were not happy with US data because the beauty of the Spanish data is that it's not CompuStat. So it's not only about large market finance firms. This is, I mean, public firms that issue stock and bonds and so on. But we have firms with one employee, with two employees, that they are only funded by banks or self-funded. So this is truly, so there are no issues here about, yeah, but our sample is not biased towards a particular set of firms, okay? Then about optimal monetary policy. What we find in that case is that misallocation creates a new motive for time inconsistency. So we are going to analyze optimal monetary policy both time zero and from a timeless perspective. So time zero means we are going to analyze the Ramsey problems, the Ramsey optimal policy without any pre-commitment. I'm using Woodford's nomenclature. So what we are going to find is that even if we introduce a set of taxes such that the steady state is efficient in the case of a representative agent, so with market completeness, so that in the case of market completeness, which is the standard representative agent New Keynesian model, representative firm New Keynesian model, so the plain vanilla Gallis or Woodford New Keynesian model is a particular case of our model with complete markets. So even if you introduce taxes such as the steady state is efficient and the model is time consistent, once that you introduce this market incompleteness on the firm side, there is a new time inconsistency motive. Why? Because then the central bank has an incentive to temporarily create inflation, produce a demand shock, so reduce nominal interest rates and produce a temporary expansion in the economy, even at the cost of inflation, in order to reduce temporarily capital misallocation and increase TFP. That's this that's this time zero optimal policy. Then if we analyze timeless optimal policy, where timeless is this idea again of Woodford, that by timeless we mean that we take the model I mean, we take this economy under the optimal monetary policy, we let it run for 1 million years, then we set that into a kind of a steady state in which we have all these pre-commitments from time zero until now. And in that case, in that moment, a shock arrives where I have all these pre-commitments, so I cannot deviate from my pre-commitments. Then the timeless optimal response to cost push shock in the basic New Keynesian model follows what is called leaning against the wind, which means that the central bank tolerates some inflation but has to tighten monetary policy. So at the end of the day, the central bank is facing inflation and reduction in the output and output gap because it has to partially fight against this cost push shock. However, in the case with incomplete markets, instead of leaning against the wind, we want to lean with the wind. Why? Because when the cost push shock, if we let the cost push shock and even let the economy to overheat a little bit more, again, the demand effect associated by through this misallocation channel of monetary policy partially compensates the negative effects, so the negative demand effects associated with high inflation are partially compensated by the positive effects associated to a higher TFP, a temporary path of higher TFP. So then the optimal prescription is to lean with the wind, okay?
Galo, but couldn't all of these results, I mean, I think they are, but be driven by the fact that you're using Moll's model that basically has constant return to scale, where demand effects have a very strong effect in terms of like accumulating output in the most productive guy, and then like the effect of reducing misallocation through that channel would be stronger than if you had assumed either like decreasing return to scale or some sort of like that first based on sort of demand. So I mean, like, my point is that the optimal monetary policy, like, I mean, most of the results will be driven by that assumption.
Can be. So I cannot say, I mean, I do not want to oversell the result saying, look, this is the last word in that. No. So it can be, it can perfectly be. With this paper, I just want to make 2 points, I mean, 2 economic points and 1 technical point. The technical point is, look, there is a way to solve optimal policy problems in models with heterogeneous agents, household firms, that you leverages on continuous time, and that can be applied to any problem. And that is much simpler. I mean, with this model, we can solve it in Diner. I mean, using this for computation in Diner. So the technical contribution, but then from the economic contribution, we just want to make 2 points. The first point is, look, even if there are all these previous papers saying that low real interest rates lead to capital accumulation, these results should be taken with a grain of salt, because it's even more dependent on their assumption. So the result that all these papers get is just derived from the fact that they are assuming partial equilibrium or some general equilibrium that looks like partial equilibrium. That's the first point that we want to make. The second point is that, look, in the Moll's model with constant return to scale, this return is overturned for the reasons that I have exposed. That doesn't mean that in any model or that in the real world it is the case. I don't know. But the only hint that we have in the real world is the empirical support that we obtain from the Spanish microdata. And it's true that there are a number of papers, empirical papers, and there are papers by Luca Fornaro and so on, that through other mechanisms, so more through endogenous growth, research and development, innovation, seems to also be in line from the empirical point of view with our results. But there are different papers through different mechanisms. So this is all I can say. What I will not say is that, look, we prove that expansionary monetary policy reduces misallocation always and everywhere, because, I mean, I have no idea.
Yeah.
Okay.
Thank you.
Yes?
This is Ernesto again. Sorry for interrupting. Very quick curiosity. Why do you guys focus on cost push shock as opposed to productivity shocks? It seems more natural to me to think about productivity shock, that some reduced form shock on markups, that is the cost push, no?
So it's no. So 2 points to that. In the paper, we also in previous version we also used to have productivity shocks. The issue with productivity shocks, and now with demand shocks, and with other shocks. So with all these kind of TFP, is that in our model, I will comment that about demand shocks, but also happens about productivity shocks. Is that with these other shocks, divine coincidence holds, and the prescription of the model to these shocks is exactly the same as in the representative agent. So I was highlighting cost push because it's a shock in which it has a different prescription. But for the other shocks, divine coincidence holds, inflation is kept at 0, and the monetary policy just moves over the output gap. That was the main reason. The second, more aesthetic reason is that in this model, TFP, aggregate TFP, is endogenous because it depends on the distribution of firms about the cutoff. So then when I was talking about TFP shocks, then it sometimes produced some confusion because then you have to talk about the exogenous component of TFP and the endogenous component of TFP. But I mean, if you think about that like 10 seconds, you see that there are nothing. But in previous version we used to have. Now we make that point about divine coincidence with demand shocks. If I have time to reach, I will show it. I'm gonna skip the literature review, and essentially what I will present the model. I will talk a little bit about the positive analysis and about the normative analysis. So the model again is Moll's model with a New Keynesian model. So here the blue elements that I'm showing are the ones directly borrowed from the New Keynesian part. So there are no innovations. So we have the monopolistic competition, Rottenberg prices, the central bank following a Taylor rule, the household with labor and consumption, the capital producer in order to have price of capital. So I mean, I'm not gonna even present them. They are in the appendix of the slides. But if there are no doubts, there is nothing particular. What I want to present a little bit more is the Moll's part, which is the entrepreneurial part. Okay. Essentially, what we are going to have is a continuum of entrepreneurs that are going to be heterogeneous in their idiosyncratic productivity and in their wealth, that in this case, in their net worth. Okay. So my main focus is going to be in these guys because, I mean, not everyone is acquainted with this model. I assume that everyone knows how the New Keynesian model works. And because the dynamics of the economy are going to be given by that, because, I mean, if we eliminate the borrowing constraint, then the model collapses to the standard representative agent New Keynesian model. Okay, so as I was saying, we have this heterogeneous entrepreneur. They have this process that follows an Orsten-Uhlenbeck, so it's an AR1 in continuous time. And then firms produce inputs using labor and capital. And here is entrepreneurs can borrow capital, and the amount that they borrow is, so this is the total amount of capital, so this is their assets. A is their net worth, so this is their inside equity, and B is the amount of capital they borrow. Okay, and they do it subject to an exogenous borrowing constraint. So there is a parameter gamma such that the total amount of capital should be less or equal than this multiple or the net worth. Okay. So then the problem of the firms can be split in two parts, and the same as Moll does, and this is important. There is an kind of an intratemporal and instantaneous problem, and there is a dynamic problem. So the instantaneous problem is just to maximize, just purely profit maximization. So these guys, they rent capital, they can rent them. They can't essentially the point of the firms is that the firm can't so this is the rental rate price of capital, this is labor, and those are wages, and this is the production function with the entrepreneur's productivity, and as I was saying, constant return to scale, and M is the real price of the input good, because these guys are selling to these monopolistic producers. Okay, so they are producing. So these firms produce a homogeneous good. So all the firms produce the same good, but this good is purchased by some monopolistic that they differentiated, and then they sell it to the households. Okay, so that's it. Then the solution of this problem, the advantage is that with the continuous return to scale and the borrowing limit, what we have is a cutoff rule. So essentially, if an entrepreneur has a productivity that is time varying, so productivity again follows an AR1 process, so it's a stochastic process. So in those periods in which the productivity of an entrepreneur is higher than a certain threshold, the entrepreneur produces at full capacity. I understood full capacity that it borrows as much as it can, so its capital is hitting the borrowing limit, and that's it. I mean, so it borrows as much as it can given its borrowing limit, and it produces. Instead, if productivity is below the cutoff, the entrepreneur does not operate the firm, and what it does instead, it lends its own net worth to other entrepreneurs to produce. So essentially, entrepreneurs are borrowing from households and from non-active entrepreneurs, what we call inactive entrepreneurs. So the only guys producing in this economy are active entrepreneurs. Active entrepreneurs are entrepreneurs with a productivity above the threshold, whereas inactive entrepreneurs and households lend their capital to these active entrepreneurs. And this threshold is endogenous. This threshold is going to depend on the rental rate of capital, on wages, and on the price of intermediate goods. Okay? So then, given this
Sorry, very quick. When you say borrow capital, you mean rent capital from the household. Is the standard thing, or is something special?
Rent capital from the household. Rent capital
Okay,
from the
got it.
rent capital from the household. So yeah. I was talking about, but essentially what I mean is that they can rent up to this amount. Okay, but yeah, the precise is rent. So then the what makes this model then tractable, much more tractable, is that the profits are gonna be the profits of those entrepreneurs that produce are gonna be linear in capital. Okay, and this and this expression, capital phi wiggle, it will be more relevant later. So I will talk about that later. Okay, about this expression here. Then the second part of the problem of the entrepreneurs is the dynamic. Is the consumption savings problem. Here, we deviate from MOL, even if at the aggregate level we obtain the same result, so our formulation is equivalent. But the issue is that in MOL's model, entrepreneurs consume for themselves. Okay, so they are risk-averse guys who eat. And when you solve it, it looks like a Merton model, and essentially entrepreneurs consume a fixed amount of their net worth every period. That's in MOL model. We didn't want to follow that because as we are going to compute optimal monetary policy, what we didn't want to have was to have to decide about Pareto weights between entrepreneurs and households. And we didn't want to have a paper of class wars. We didn't have a paper of, no, the central bank is favoring the households on behalf of entrepreneurs and redirecting resources. So we wanted to avoid that. So instead, we pick an equivalent formulation from the point of view of the dynamics, but that avoids this kind of having two households, which is this kind of Gerler-Karadi approach. So essentially what we assume is that entrepreneurs come from households. So households send this, a household can be split into a worker and an entrepreneur. The entrepreneur operates as an entrepreneur for an exponential amount of time, and then it can pay dividends to the household. And then with a Poisson arrival rate eta, an entrepreneur retires, and then it's replaced by another entrepreneur from the household. So then the issue here is that the value function of the entrepreneur in that case is that the entrepreneur discount using the stochastic discount factor of the household, as this is going to be a perfect foresight model, I will talk more about that later, is just the real rate plus the Poisson arrival rate. And then the value of a firm, of an entrepreneur, is the flow of dividends plus the liquidation value. So when you retire, what you do is, as an entrepreneur, is that you sell, your net worth to the households, and then you are replaced by another entrepreneur. So then this is the law of motion of the entrepreneurs, which is just the savings. The savings plus the dividends is just the profits. Okay, the profits from operating and the return on capital. So this is the return on capital. So this is given your current net worth. That's the return on capital. No matter if you invest in your own firm, or you lend to another, you give your capital to be rented, to be precise. You give your capital to be rented by another entrepreneur, or you operate your firm, okay? And then again, the beautiful thing of this environment, given the linearity of this object, is that both here, as in Moll or as in Gerler-Karadi, the dynamic programming problem of the entrepreneurs can be solved with paper and pencil. So essentially, entrepreneurs never distribute dividends until liquidation. So they just because they, it's always worthwhile not to pay dividends, and then they just keep retain dividends, accumulating net worth until they have to liquidate, and then they just liquidate and come back to entrepreneur. Okay, and then the new entrepreneurs, we assume that an old entrepreneur is replaced by a new entrepreneur with the same productivity, but that starts with a lower, this psi constant, a lower net worth. So essentially, when you the whole model is equivalent, like the same as in Moll. At the aggregate level, entrepreneurs in malls, they pay raw net worth to the households, and here they pay 1 minus psi net worth to the household. But this is, at the end of the day, this is a model of constant dividends. For good or bad. Some people, when they have seen the paper, say, yeah, but then in your model, the issue that dividends just move mechanically with net worth. It's true. It's true. So this is not a model about optimal dividend smoothing. At the aggregate level, dividends are just, households just get a fixed amount of the net worth of the firms, of the entrepreneurs, in the form of dividends. And here, the issue is that the state variable of this problem is going to be the distribution of entrepreneurs. So the distribution, this model does not collapse to any kind of representative. In discrete time, with IID shocks, you can aggregate the whole model, like happens in Bernanke-Gerler-Rilkreis kind of structure. But here is not the case. Here, what we are assuming that TFP follows this persistent process, this AR1, this Orsi-Uhlenbeck process in continuous time. We need to keep track of the whole density, the density of entrepreneurs according to their TFP and to their net worth. And this is given by a Kolmogorov forward equation. So essentially, the Kolmogorov forward equation is a partial differential equation that captures both the dynamics of the distribution. It includes terms about how the savings of the entrepreneurs move the distribution, how the idiosyncratic TFP shocks change the distribution, and also about how the entrepreneurs that retire and entrepreneurs that enter change the distribution. Okay. One advantage of this, of having the linear policies, is that, the same as happens in Moll, instead of having to work with the whole two-dimensional distribution, we can integrate in something called the net worth shares, which is the share of the total net worth that is held by entrepreneurs with productivity set. So that's the definition. And then it follows this partial differential equation. So the state variable in the end that we are going to be working, instead of the whole, so essentially what we are going to work is with the net worth share. What that essentially is telling us, given an amount A of net worth, capital A is the total amount of net worth, of capital of net worth of the entrepreneurs, how it is allocated across firms. So this is, I mean, this is something that that adds up to 1, but it's telling you, I mean, which is the share of net worth held by entrepreneurs with this amount of productivity. Okay. Then, if you do a little bit of math, what you obtain is that the whole model is isomorphic to the standard representative agent New-Keynesian model. The only difference is that in the aggregate product, I mean, is the standard representative agent New-Keynesian model with capital and capital cost, okay? But the only difference is that the aggregate production function features this TFP that is endogenous. So exogenous TFP is 1, but the TFP that you see in the aggregate production function essentially is the mean of the productivity of the active entrepreneur. So it's the mean across this endogenous density omega of the density of the entrepreneurs conditional on having productivity larger than the cutoff. So essentially, this is, I will show in a figure, that's it. So if in a moment in time, because this is a time varying object, if in a moment in time, this is the density of net worth share, so this is the productivity, and this is the cutoff, the TFP is the conditional mean of this blue part. This is the same in mole model. So all this I've explained, with the exception of this issue of the Gerler-Karadi, but that changes nothing, except that we can only focus on the welfare of the household in the normative part. This is the moles model. For those of you who were, I mean, the moles model with wages and capital. I mean, he also has wages, but with endogenous labor supply. I mean, with all the new Keynesian structure, but it's moles model, okay? So the rest of the elements, again, I'm not going to present them because they are the same. Representative household, capital good producer, retailers, final good producer. Okay? Any questions so far? Okay. So now, if I'm not mistaken, I still have 25 minutes. Am I? Okay, I assume I have.
Yes.
Okay. So now I'm going to present first the positive results, and then I will talk about the normative results. About the positive results. So how does monetary policy operate here? So here monetary policy affects TFP. So given the definition of TFP, monetary policy can't affect TFP in this model only through 2 channels. One is that changing the cutoff. The other is changing the distribution. So if monetary policy changes the cutoff, it will modify which firms produce. And if it changes the distribution, it will change which is the conditional mean. Essentially, that's the idea. The first of this channel, we call it the productivity threshold channel. So essentially, it is the channel highlighted by the early literature. So it is this idea of the ice cream shop. If monetary policy affects the cost and the profits of firms, I mean, in general, the profits, because monetary policy affects funding costs, but also wages and prices of intermediate goods. In a way, for instance, here, if monetary policy tightens or relaxes, in this case, tightens the threshold, it will increase TFP. If it moves the other way around, it will relax it. And then we have in the paper a number of analytical results. So in a partial equilibrium environment in which we keep all prices constant, so wages, intermediate goods, capital prices constant, and we only play with real interest rates that affect rental rates, a reduction in real interest rates reduces the cutoff, or an increase increases the cutoff. And there it can be proved that it has the same effect on aggregate TFP. So a reduction in real rates, reducing the cutoff, allows less productive firms to enter, less productive entrepreneurs start producing, and the result is that aggregate productivity is reduced on impact. That is what we call the direct effect of monetary policy. However, if we do the same exercise for the other prices, so now we keep everything constant, but now we play with other prices, this we call the indirect effects using this nomenclature in Kaplan, Moll, and Violante. What we find is that, I mean, results depend. So wages and capital prices move in one way, whereas intermediate good prices move in other ways. And a monetary policy shock will affect in differential ways real interest rates, wages, capital prices, and intermediate good prices. So the result the conclusion of our analytical result of this channel, which is the channel in the literature, is that you cannot claim that monetary policy increases misallocation. It only happens in partial equilibrium. But once that you take into account general equilibrium effects, everything can go. It can increase or reduce misallocation. It's going to be a numerical conclusion, not a theoretical conclusion. And the second channel is the network distribution channel, which is on impact. This is not a channel that happens on impact. Actually, this is not something that is even affected by real interest rate. But by changing other prices, firms can accumulate more profits or less profits. This accumulation of profits can be heterogeneous across productivity. So not all firms accumulate profits at the same rate. And that can produce changes in the shape. So that makes that the distribution can be shifted, but not only shifted, it can be deformed. And this is what we call the network distribution channel. So the network, the distribution of capital across firms is also going to be affected by monetary policy, not on impact, but across time after a shock. So then the direct effect of monetary policy in TFP is positive, but the overall effect is completely ambiguous. So what we do is that we calibrate the model as best as we can. Yes?
Quick question. Can you go back?
Sure.
I'm a little bit confused about what the effect. I understand the effect on TFP, for example, the direct effect, but that is not necessarily due to misallocation, right? That has to do with this threshold and
I mean,
TFP
by misallocation here, I mean, so by misallocation in this model, misallocation means that TFP is endogenous, and that TFP depends on the distribution of capital across firms of different heterogeneity, of different productivity. In an economy without financial frictions, this there is no, in an economy without financial frictions that we will discuss in the so when gamma is infinite, what happens in this economy is that the most productive firm takes the whole market and produces everything. Okay. So the point of misallocation in this literature is the presence of firm heterogeneity and financial frictions makes aggregate TFP a function of the distribution of capital across firms. That's the meaning of misallocation. And then if you take that definition of misallocation, monetary policy affects misallocation by changing the distribution of capital across firms. I mean, both the distribution and the threshold, because what matters is the distribution of capital across firms that are producing across active firms. So essentially.
Okay, I see, I get it. So you don't have love for variety here.
No.
Okay, perfect. I was confused on that. Thank you.
No, so it's true that, I mean, now there are a number in the paper we discussed. So now there are a number of papers that so there is, I mean, the most, in a way, the paper that is more similar to us, even if it has nothing to do, is a paper by David Bucky and Emmanuel Fari and a third author that I don't remember his name, that makes very similar claims to us. It doesn't have any optimal policy, But this is a model about heterogeneous markups. So theirs is a model about varieties, preference for variety, markup heterogeneity, and then it's all about firms with higher markups, firms with lower markups. And I've seen David presenting it a couple of times, and then everyone was talking about more productive and less productive firms, and he was all the time insisting, no, this is not a paper about productivity, because in our paper, all the firms are as productive. It's about markups. This, in contrast, our paper is about productivity. It's not about markups. So markups, it's the same for all firms. It's for all different firms. It's about markups. It's about productivity. It's all about which firms are more productive, depending on their size. So now we calibrate the model. And
sorry, very quick clarification. M is the intermediate inputs for production?
Yes.
Why do you need that for the story?
So M is the price of intermediate good, because the structure of the model is that the entrepreneurs sell their goods to the retailers. So this is M. M is the price of the input good. And these are the ones who do the monopolistic competition and where there is the price stickiness. And then they
The
sell.
question is because BASU AER 1985 is a paper that actually the name of the paper is like aggregate demand looks like supply shocks or productivity shocks, something like that. So I see that in the story that you are telling us, there are two elements together, and probably you want to isolate only those related to capital and not the action on aggregate productivity coming from the reaction of intermediates.
Yeah, what we wanted to avoid, both for tractability and to keep our heads cool, was what we didn't want to mix was the monopolistic competition with the financial heterogeneity. I mean, what we didn't want to have is that we didn't want to mix the retailers with the entrepreneurs. What we didn't want to have is that most productive firms, they can have higher markup or lower markup, they face different. So what we wanted to avoid was the issue of the monopolistic. I mean, the monopolistic competition part with the financial part. Again, then you can say, yeah, but what if this you did that? Could that overturn the results? And I said, definitely. I mean, I don't know how to do it.
No,
but
I'm not saying that cannot overturn the result. I'm saying something much simpler. If you tell me that monetary policy affects misallocation, I say, yeah, we know it from BASU 1985 through intermediate inputs mechanism. This paper is about the capital mechanism. So probably we should focus on that.
Okay. I mean, I don't know the paper, so I don't know how to.
I can send you the reference later.
Okay, so I don't know how to answer, but it can be. I mean, I know we are not citing it, so, but yeah. I mean, that can definitely be. So in a way, in that way, we are trying to. So our model is very similar to the one of Gopinath. The one of Gopinath is a partial equilibrium version of our paper, with also constant return to scale, but with monopolistic competition on the size of the entrepreneurs. So it's like they have decreasing return to scale, and with a model in which the borrowing limit is size dependent. So it's more complicated than ours. And the one by Adrian et al., this is literally like a partial equilibrium real version of our model. Is exactly the same. So we were trying to stick to the models in this literature, which is the literature that was making those claims. But I was unaware about this paper by Basu. So I mean, I think it's worth having a look. Thank you. So the input responses. So this is a numerical. Now we calibrate the model and we solve the model. In the paper, we make a fuss about how we solve the model, because at the end of the day, this is a heterogeneous firm model. So we need to solve the model. I mean, here we have to compute MIT shock, transitional dynamics, and so on. The way we do it is a novel mechanism to solve. It has a flavor similar to this sequence space algorithm, or of Adriano Clare, Straub, Rongley, and co-authors, but it's different. So essentially, we exploit the advantages of continuous time in order to solve the dynamics of the model. So we combine, and the good thing is that it can be solved in Diner. In Diner, it's true that using 1,000 or 2,000 state variables, but you know that in Diner, you can build 4 loops. So this is a high dimensional model because essentially we treat each grid point in the distribution as a variable and we propagate it. But given the advantages of continuous time, we make no approximation here. So that gives us a very high accuracy of the simulation. It's very fast to solve. I mean, it solves in a few, I mean, in 1 minute or a couple of minutes. I mean, it's very fast. It's simple to program if you know Diner. If you know how to program loops in Diner, because you need to be all the time filling arrays in Diner, but it's quite convenient. And it will be paramount when we talk about optimal policies, okay? But from the point of view of the results, is that what we see is that a monetary policy is in shock, increases TFP. So this is TFP, and you see how TFP increases with time. So on impact, almost no effect, and then increases with time. And it increases with time through both channels. Both the threshold increases and the net worth channel, and we are going to characterize the net worth channel by the slope of this slope of the profit function. So if you remember when I talk about the profit function here, I talk about this slope, and I said this slope is going to be very important because essentially this slope of the profit function can be proof that the slope of the profit function takes into account the dynamics of the drift that accounts for the dynamics of the distribution. So the slope of the profit function, if the slope shifts, that means a shift in the distribution. If the slope tilts, that means a deformation in the distribution, in the density. Okay, so both channels operate in a way that favors an increase in endogenous TFP. And then the rest of the variables move exactly as in the New Keynesian model. Then why do they move like that? In order to do that, you really need to do a decomposition of this profit function and of the threshold. So here what we do is an analysis equivalent to the one that Kaplan-Moll Violante do in their model. So what we do is we take the model, we keep so we take the agents in the model, the firms in this case, we keep all the prices constant at their steady state, but one price that we plug in the one in the path. And then we simulate the firms in order to see how these profits change. And this allow us, and they coincide with the analytical results. So they allow us to decompose how the effects of real interest rates, of capital prices, of wages, of intermediate good prices affect. But at the end of the day, the bottom line, because I mean, I have 10 minutes and I want to talk more about the optimal policy because I like it a lot. The key issue is that if you look at the blue line, the solid blue line, and the solid grid line, what you see is that there are these two effects. On the one side, there is this small shift to the right, that is this threshold channel, and on the other side, there is this upward tilting. This is the net worth channel. So what it is telling us is that the productivity threshold, despite the fact that real interest rates are going down, it is not that less productive entrepreneurs are entering the market. On the contrary, it is that entrepreneurs, low productivity entrepreneurs that were producing are pushed out of production because of this shift here. Why? Because wages are increasing. So and input prices are also increasing. And then at the same time, there is a second effect that is quite relevant, which is this increase in the slope. This increase in the slope means that the profits per level of productivity, or the profits as a function of the productivity level, increase. That means that high productivity firms are making more profits. You may say, yeah, but it doesn't look that big. Okay, it doesn't look that big because of the scale, but it matters a lot. So this is enough to produce this increase here and to produce this increase in endogenous TFP. Okay. So that is mean. So now that opens two positive questions. First is yes.
Yeah, Gonzalo Garcia Trujillo here. Just a quick question. The shift in the right tail of the productivity distribution is because the incumbent high productivity firms are producing more, or because you are seeing entry of firms with a higher productivity? Which of the two margins are
so at the
matter
same,
most for?
So this is, so here what we are plotting is the deviation of network share. So we are taking the density after 1 year minus the density at time 0, and we compare. So if it's negative, this means that there are less firms. If it's positive, that means that there are more firms. So what we see is that on the one hand, there are less firms that are active and that are producing, and so there are less low productivity producing firms, and at the same time there are more productive, more high productivity. So the density is shifting to the right. So the density is shifting. So the threshold is shifting to the right, and the density is shifting to the right. And why is it? And why the density is shifting to the right? Because these firms here that make more profit can grow. So essentially, every firm with a productivity larger than around 1.2, something like that, is making more profits. So as they make more profits and they don't pay dividends until they retire, they accumulate more net worth and then they grow more. So then the mass shifts to the right. Okay. So two questions. First, do the data can say something relatively to that? And then the only thing that we were able, so we didn't know how to test the issue of the productivity. So the only thing that we can test is this sentence in red. We test that after a monetary policy expansion, high productivity firms increase their investment relatively more than low productivity firms, which is exactly what this figure is telling us. This, how do we do it? We use, as I was saying, this quasi-universe of Spanish firms. And then again, in this paper, we try to innovate as less as possible, except on the optimal monetary policy algorithm. So we do exactly the Ottonello-Winberry. So we take the monetary policy shocks from Jaronczynski and Karady. We use exactly the same specification as Ottonello and Winberry, but the only difference is that instead of trying to analyze the effect of default on investment, or of monetary policy and default on investment, what we care now is about productivity. And we proxy the productivity by the marginal return of capital. But it's exactly, we mimic everything, the controls and everything, as in Ottonello and Winberry, and we have done a lot of robustness analysis that is in the paper. And we find is, I mean, let me skip a little bit this part first, because I want to complete the paper, and second, because to be honest, I haven't done the empirical part, so I'm a complete ignorant of these econometrical issues beyond what is a local projection. So probably if you have questions, I wouldn't be able to answer them. But what I can say is that Beatriz and Silvia, who are the ones who know about these things, they find us in that yes, that the answer is significant, that that after a monetary policy expansion, high productivity firms increase their investment relatively more than low productivity firms. A parenthesis, and that I want to devote like 1 minute. That doesn't mean that a reduction in real rates increases TFP or reduces misallocation. Again, no. It depends on the nature of the shock. So in order to compare again with the Adrian, Martin, Van Asco, and so on, Leven paper, we analyze also a demand shock. And the demand shock produces a similar fall in real interest rates. And it's also a demand shock. So, and a monetary policy is a demand shock. So by a demand shock, I mean an exogenous reduction in the, or increase in this case, in the reduction in this case of the subjective of the discount factor of the household. It's a demand shock, so output increases, wages, prices, inflation increases prices of capital. However, TFP decreases because these two channels move the other way around. So again, this is not a matter about demand versus supply or monetary. This is just, in the case of everything depends on which is the relative weight of the different general equilibrium effects. So this is a topic to be very nuanced about. So this is not a black and white issue. So we find that considering a different shock, a demand shock, that the input responses qualitatively look similar for the New Keynesian variables. However, the impact on TFP is totally the other way around. It's the other way around. And I could explain you why it is, but let me focus on optimal monetary policy because can I take, I have 4 minutes. Okay, I think I can do it.
Galo, you can take like 5 or 10 minutes more if you want.
Okay, yeah, I will take because I want to take questions, so I will try.
Yes. Don't worry.
5 minutes. So about optimal monetary policy, how do we define optimal monetary policy in this case? So essentially, the Ramsey problem in this case is the central bank maximizes, so chooses nominal interest. So those examples here were with a Taylor rule. Now we assume that the central bank chooses nominal prices in order to maximize the welfare of the representative household, subject to all the prices. Subject to the private equilibrium conditions and the initial conditions. So essentially, we take all the equilibrium conditions, like the Euler equations, everything, the law of motion of the distribution. So one of the conditions is the law of motion. So this is a condition for the central bank. This is a condition for the central bank. So the central bank sees the whole of the economy and has to choose nominal rates in order to maximize welfare. But then the way that you do it is that you have to build a Lagrangian in which at the end of the day, the central bank has to respect the equilibrium condition, but chooses everything. So the central bank chooses the distribution, consumption, everything is chosen by the central bank plus the nominal interest rate. So this is the standard definition of a Ramsey problem, of optimal monetary policy with commitment. What makes this problem especially tough is that we need to keep track of the whole distribution of firms. So this is not like in the standard thing that you take the first order condition and then you take the derivative, because here you would need to take the derivative with respect to a distribution, with respect to a density, which is an infinite dimensional object. So that makes, and then you say, yeah, but why if we discretize it? Okay, but even if you discretize it, then the problem is that what you have is a problem with a extremely high dimensionality. And this is what is making this issue of solving optimal policy in model with heterogeneous agents very, very complicated. And this is where we see that, if this paper is to be remembered in 15 years, it's not going to be by the economic conclusions. It's going to be by the algorithm. The same as no one remembers the Classell-Smith paper by their insights about, it's about their methodology. So the point here is that we introduce a new algorithm. The new algorithm can be summarized here in a way. We depart from a model that is continuous time and continuous space. So it's infinite dimensional both in time and space. In a previous paper with Carlos Thomas, we proposed a model a way to solve these kind of problems. The idea is you write the Lagrangian in an infinite dimensional space, in a Hilbert space. Then you take infinite dimensional derivatives, which is like in calculus of variation. So you take perturbations. And then you obtain a new system in which now you have distributions of Lagrange multipliers. So some of those Lagrange multipliers are backward looking and they look like value functions. The interpretation is that they are the social value functions. That is the value that the planner assigns to the household that does not need to coincide. So they are computed through Bellman equations. And other Lagrange multipliers are also distributions, but are backward looking, and they are seen as commitments. So they began with a Dirac at delta, and those can be interpreted as in Butford are the commitment But then now the central bank is when the central bank announces a path for nominal interest rates, it is progressively making commitments, and those commitments has a different value for different households or entrepreneurs in our case. So the interpretation of these Lagrange multipliers is the value of deviating from the commitment that you have made to a particular agent. Okay, it's an extension of the concept of commitments in basic optimal monetary policy. The problem is that now that you have that, what you have is a huge model of heterogeneous agents, because now, in addition to the Bellman equation of the agents and to the state of the agents, now you have to keep track of this Bellman equation of the social value functions and to the distribution of the promises. But then you can discretize them and solve them using finite differences or neural networks or whatever. But the problem with that is that it is a pain in the ass. It's very complicated to do numerically and also analytically, because you have to spend pages and pages taking the derivatives by hand. So in this paper, instead, we chose the alternative, which is why instead of computing and discretize it, we don't discretize and then compute. So we can take our model, discretize using finite differences, and make our model become a discrete time, discrete space model. That is a model that we have solved in Diner to compute the input responses. And then we can compute the first order condition using symbolic differentiation, taking the derivatives. But the good thing is that there are many packages. In MATLAB, you can do it. In Diner, you can do it. And then once that you have done that, you just have this expanded, but now it's a discrete time, discrete space model, which are very simple to, very simple to solve. We know how to solve them for 20 years. And this is what we do. And this, for a relatively small model like us, a model with 1,000 state variables, a model in which we will have like 3 idiosyncratic state variables in the entrepreneur's problem, probably Diner would have a stack overflow and would not be able to work with that. And you would need to program the symbolic differentiation by yourself. But in this model, which is relatively small, conditional on being a heterogeneous agent model, we can do it. But then the question is, are we sure that both approaches produce the same results? And here we have a theorem in the paper where we prove that solutions converge as delta t goes to 0. So the smaller the time step, the safer we are about our methodology. And we have also tried this method in my paper with Carlos that was solved using this way, and was solved the other model, totally different model, with the 2 methods, and results coincide. So we are sufficiently reassured that the methodology is correct. So at the end of the day, and I will not, for those of you who have followed the course, this slide can be of more interest, but at the end of the day, you will remember the equations for the Hamilton-Jacobi-Bellman equation and for the Kolmogorov forward. And this is what we plug into Diner. Those are large vectors. And then we let the optimality conditions to be computed using symbolic differentiation. And then we use a Newton algorithm as occurred in order to do this backward-forward time iteration in a model without uncertainty. But then, as we know, the optimal response, and this is also a blink for those of you who follow the course, that the response to an MIT shock is the same as the input response. So then the response to an MIT shock will give us the same as if we have aggregate uncertainty. And now, just let me devote 2 minutes to the results, and I'm done. First we solve, as I said, the model, the time 0 model. So the model without any pre-commitment. So at time 0, the value of the Lagrange multipliers is 0. So there are no existing pre-commitments. So in this case, with complete markets, we introduce the taxes such that 0 inflation is optimal. So this is not about the timing consistency associated to the Phillips curve. No, this is not going to be exploited. So here we are, this is the red line is the complete market benchmark. So no change with time consistent, because the initial value is the steady state. The zero inflation steady state, which is the optimal steady state of this model, is the initial the distribution and all the variables. So this is the initial situation. So now, given that, no shocks arrive. So it's just that we give the central bank the opportunity to re-optimize. And then the optimal path is to generate surprise inflation, I mean, to reduce real interest rates, again, by increasing all these things and producing this increase. And actually, what we did is that, oops, the monetary policy shock, are you still with me or? The monetary policy shock that we calibrated before was calibrated to exactly replicate the optimal path of monetary policy. So this was the way that we calibrate the shock, such that so essentially the bottom line is that surprise inflation is optimal since it reduces capital misallocation. And then the last slide that I'm presenting, I mean, yeah, I'm not presenting demand shocks. It's about the timeless. So now we consider timeless optimal policy. So again, we let the economy run for 1 million years. We find a new steady state, but now this is a zero inflation steady state, but the Lagrange multipliers of the central bank are at the steady state values when a shock arrives. And now a shock arrives. I mean, Diner does all these things automatically, but it's for you to understand what we are doing. So here we can compare the timeless complete market. So in the timeless complete market, inflation increases a little bit and output decreases. This is this leaning against the wind. However, here inflation increases much more and output increases too. And why? Because now TFP is increasing. And we take the model with heterogeneous agents because we wanted to disentangle which part of this response was due to the optimal policy and which was part maybe to having some, I mean, something that we were overlooking. So in order to test, what we do is we take the model with heterogeneous agents, but we plug the optimal policy of the model with complete markets. This is this yellow line here. And we find that in this model, the model still performs very similar to the model without with complete markets. So the bottom line here is that firm heterogeneity matters. Firm heterogeneity matters for the optimal conduct of monetary policy. So in order to answer the question that I made, central banks should take misallocation into account. Misallocation affects the optimal, not always, but in certain shocks, central banks should take into account which are going to be the effects of monetary policy on the distribution of firms, which firms are going to benefit or are going to suffer more. But the result that monetary policy always and everywhere, expansionary monetary policy increases misallocation is a mistake. It is just a reading of some particular examples. So in general, everything can happen. And in our model, in our particular model, under our particular assumption and under our particular calibration, monetary policy actually does the other way around, and expansionary monetary policy increases TFP and reduces misallocation. And with that, I'm done. Thank you. I don't know if we have time for one question or two.
Thanks, Galo. Anyone has any questions?
I have one, but I would like let others to talk first. If we have time, we could get back or talk to Galo later.
I have a brief question. Galo, this is Federico Uneos from the Central Bank. So on the last thing you were saying, have you explored computationally kind of show which parameters and which parameter values are the most important ones to kind of shift the relevance of the partial versus a general equilibrium effect in terms of whether misallocation increases or decreases, to kind of get a sense on the model, like which ingredients of the model are more important for one or the other effect to kind of dominate numerically. I guess you can do something like, show with different parameter values, shifting kind of margin of these things, and kind of seeing at which point the tide sort of shifts towards decreasing or increasing misallocation.
We have not, and we should have done it. I mean, that's I feel kind of ashamed because this is something that we should have done it in order to. It's true. I mean, to be honest, I mean, probably. I mean, the impression that I have about the paper, I mean, and it's my own paper, is that the optimal. I mean, the explanations, and this is in partially because it's more difficult to understand. We don't have such a clear view of what drives the result in the optimal policy part than in the positive part. We put a lot of emphasis on the algorithm and not that much then later of the effort on the interpretation of the results. And I think that what you suggest is a very good avenue because it's true that we could just keep on plotting things under different parameter values in order to get a sense of which dimensions of the model drive most of the results. And yeah, we have not done it, and we should have done it, and we should do it. So yeah.
There's a way of systematically doing this, which is kind of in the spirit of, Gensko, Andrews methods of estimate of checking the sensitivity of parameter values and moments to estimation of structural models that I think can be sort of applied here in terms of understanding which margin of the model is more sensitive for misallocation going up or down, depending on parameter values and so on. So maybe that might be useful.
Would you be so kind to send me the paper?
Yeah.
I don't know which paper.
I'll send you.
So can and I also don't forget about the Basu paper. So if you both are so kind to send me the papers, I would be very grateful.
Any other question?
It's
Ernesto?
time for one more.
I think so. 2 minutes.
Okay.
Yeah.
So Galo, I'd like to give you the opportunity to explain us again without all the techniques and all the high-tech stuff, the intuition why optimal monetary policy under commitment is different than in the standard setup. In the standard setup, as far as I understand it, is as follows. There is a cost push shock. The central bank has a tendency to increase rates, but since it has commitment, it promises a recession in the future. Expected inflation goes down. Therefore, it doesn't have to increase the rate so much today. Since this is less costly, it can engineer price level targeting, which is something that it cannot do when it cannot promise future recessions. What is different here?
Oh, that's a good question. I mean, I wish I can give you such a clear answer. Unfortunately, because I mean, in order to that, the advantage of first, let me say two things about the standard explanation. So about the standard explanation, it's true that the standard explanation works well in the 3-equation model, but once that you introduce capital, there is a very recent, I forgot the authors. I hope it's none of you, but there is a very nice paper in the JME, and there was also an older paper by Esther Faye on that once that you get the New Keynesian model with capital, for instance, many of the results are overturned. This is one of the reasons why we introduced capital adjustment cost. This is just a curiosity. Maybe all of you know that, but I wasn't aware that in the New Keynesian model with capital, no heterogeneous fairness, whatever. I mean, in the standard representative everything New Keynesian model with capital, without capital adjustment cost, nominal a reduction in nominal rates increases real rates. So these Taylor principles are totally not only the Taylor principle, but in general, the traditional explanation of how monetary policy works, like you reduce nominal rates and hence due to price stickiness, real rates go down and then real rates propagate to the economy like that. These things, if you have capital in the model, the movements in capital they overturn that, and nominal and real rates move the other way around. And if you want to recover, as we have in this paper, this kind of intuition that nominal and real rates move in the same direction, you need to introduce some form of capital adjustment cost. This is what we did. Now, that was a side comment. Now, coming back to that, the explanation that we give to ourselves about what is happening here, given that we are not able to produce any kind of second order approximation of the object of the central bank in order to decompose, like, I mean, it would be nice to have this kind of inflation quadratic, output cap quadratic, and another term that explains, but we are not able to do that because the model is too complicated for us to do it. The interpretation that we give it in this paper, also comparing with the baseline with the suboptimal policy, is that in this model, instead of engineering a recession in order to cool the economy, the central bank is willing to tolerate this increase in inflation that is welfare reducing, because at the end of the day, from the total productivity point of view, this increase in inflation is reducing the total amount of output because there are Rottenberg costs. But at the same time, this increase in TFP is increasing the total amount of output because it's increasing productivity. So, and also, even if not shown here, also investment is also increasing. So at the end of the day, the central bank trades off the reduction, I mean, a trade-off that does not exist in the other paper. In the other paper, you only have, well, I mean, you only have the issue of output gap versus the size of the pie through inflation. So you want to engineer this recession, so you want to make people work less in the future in order to avoid this destruction of resources through inflation. Today, however, here you are willing to tolerate this destruction of resources through inflation today, because the pie is gonna become slightly larger tomorrow through the expansion in TFP. But that's it. But again, this is I mean, this is something I'm very careful about. I like a lot the paper by McKay, Nakamura, and Station, the Forward Guide and Path All Revisited. This is a paper, when it was released, I was super enthusiastic about the paper. And then when Ivan Bernin and Ferin Bilby and others have came with this paper, so we look, the explanation that was in that paper, that was totally plausible. And the numeric seems to fit the explanation, was wrong, because that is this issue about the allocation of profits across household. That always makes me be a little bit cautious about giving the explanations, because at the end of the day, we see the results of the computer, but so my interpretation is this one. But given that we don't see, I mean, given that we don't have the criterion of the central bank in the sense of these variables, we just know that the central bank is maximizing the expected value of the utility of the household, but we don't know how to disentangle that into inflation, output gap, and other variables. I cannot sell, unfortunately, and to me this is one of the shortcomings of the paper. But I don't know how it can be solved. I cannot give you a better explanation. But if you come with one, send me an email and I will get it into the paper.
I think I have one, but I don't know the model enough. My sense of what you said is that basically this is equivalent to have a target on output, basically because the rate where you start from is not the socially optimal rate. So the central bank is going to try to undo the friction, and that's why it decreases rate any time that find opportunity, for instance, in these IRFs. But I don't know, I'm too far from the paper to say that. No, it's just a conjecture.
What I mean, in this particular case of timeless, what makes my head a little confusing is, like, okay, we are analyzing a negative shock, but what about a positive shock? So in the event of a positive shock, what the central bank is facing the cost of deflation and then tolerating a fall in output and reducing TFP. So how can that be that it is optimal? And as at the end of the day, shocks are symmetric, for every time that you lean on one way, you have to lean on the other. And I don't know why.
But here it's not going to be symmetric. That's for sure. So it's not a standard linear quadratic model where everything is symmetric. It's not going to be symmetric.
Yeah, that's also true.
Because of the cost of misallocation.
That's true that it is not symmetric. Yeah, that's a good point. This is true. This is true that it's not symmetric. Yeah, so yeah, I mean, you have point to me to what is the weakest point of the paper in terms of the economics. But yeah, I mean, your explanations, I mean, this is a good point. And to me, I wish I could, but yeah, I mean, this issue of targeting output can be, but yeah, I don't know how to articulate better the explanation here. I mean, that's a problem when we go very deep into computational issues in models that are not like super well understood. That sometimes you thread into these kind of things that you don't know what is what. I mean, we have done a lot of checking to check that the results are correct, which was my initial concern, that it is not any kind of glitch of numerical error driven things, whatever. But after months, when we concluded that really it is correct, then I mean, it is like that. We know it is like that, but I cannot give a truly convincing explanation of why it is.
Thank you. Great paper.
Okay, Galo, thank you very much for your seminar. We ran out of time. It was very interesting. Thank you very much also for this week. On behalf of everyone here, I think we all enjoyed this week, the course, the seminars, and etc. I hope these open lots of avenues for research at the Central Bank of Chile, and we hope we can work together in the future, maybe.
Yeah, I hope that when this COVID passes, I can go there sometimes, because I would really like. I mean, I would like to meet you in person and to talk and so on.
Okay, so we are gonna close the webinar. So thank you all for coming, and see you next webinar series of the Central Bank.
Thank you very much. Just as a final word, you know that there is this agreement between the Bank of Chile and the Bank of Spain. So if any of you is interested in spending some physical time here in Madrid, we welcome you with open arms. So just drop me an email. I mean, this is I don't know if
this is symmetrical.
It is symmetrical, exactly. But
so
Elvira,
you can come here too.
I can go. Yeah, that's also true. Elvira was there. And this is why, as Elvira was there, now it would be nice if someone comes. So we are more than happy to host you or to do whatever you want to do here. I mean, any pair of hands will be welcome. So, and I would also love to spend some time there. I mean, so if, I mean, for the future, yeah, I keep it in my mind. Anyway, thank you very much.